The delta hedging trading strategy. Delta hedging is a strategy used in options trading to reduce or eliminate the risk associated with price movements in the underlying asset. The goal is to maintain a position where the value of the portfolio is not affected by small changes in the price of the underlying asset. It is a measure of how much the price of an option is expected to change based on a $1 change in the price of the underlying asset. It ranges from 1 to 1. For example, if an option has a delta of 0.5, the option's price is expected to move by 50 cents for every $1 move in the underlying asset. Understanding delta is crucial in the context of options trading. For example, a delta of 0.5 indicates that for every $1 increase in the price of the underlying asset, the option's price will increase by 50 cents. Delta hedging works by balancing the delta of an option with an offsetting position in the underlying asset. Key concepts in delta hedging include delta, gamma, or the rate of change of delta, theta or time decay, and vega the sensitivity to volatility. 3 mechanics of delta hedging. 1. Positive delta. Call options have positive delta values, meaning they increase in value as the underlying asset's price rises. 2. Negative delta. Put options have negative delta values, meaning they increase in value as the underlying asset's price falls. 3. Delta neutral. A portfolio is considered delta neutral when the total delta is 0, indicating that the portfolio's value is not affected by small changes in the underlying asset's price. Delta hedging involves adjusting the positions in the underlying asset to offset the delta of the options. The goal is to create a delta neutral portfolio, where the overall delta is 0. This neutralizes the impact of price movements in the underlying asset on the portfolio's value. A delta-neutral position is one where the total delta of the portfolio is 0, meaning the portfolio's value does not change with small movements in the underlying asset's price. Just a quick reminder to please hit the like button and subscribe to the channel. Also, visit us on the web at www.investmentees.com and use code BLOG to receive 25% on your next purchase. There are various strategies employed in delta hedging. Static delta hedging. Static delta hedging involves setting up a delta-neutral position at the outset and making minimal adjustments over time. This approach is less labor-intensive but may not provide the same level of risk reduction as dynamic delta hedging. Dynamic delta hedging. Dynamic delta hedging requires continuous monitoring and adjustment of positions to maintain a delta-neutral portfolio. This strategy is more effective in managing risk but requires significant time and resources. Gamma hedging. Gamma hedging is an advanced form of delta hedging that involves managing the gamma of the portfolio. Gamma measures the rate of change of delta with respect to the underlying asset's price. By hedging gamma, traders can maintain a more stable delta over a range of price movements, further reducing risk. Delta hedging practical applications. Institutional investors. Large institutional investors use delta hedging to manage the risk of substantial portfolios, ensuring that market movements do not significantly impact their overall performance. Retail traders. Retail traders also employ delta hedging to protect their investments, particularly when dealing with highly volatile assets. Market makers. Market makers utilize delta hedging to maintain liquidity in the markets, ensuring that they can provide quotes for buy and sell orders without exposing themselves to significant risk. How delta hedging works. 1. Initial position. When an options trader takes an initial position, they might buy or sell options on an underlying asset. Each option has a delta, which contributes to the overall delta of the portfolio. 2. Hedging. To hedge the delta of the options position, the trader buys or sells the underlying asset in proportion to the delta of the options. For example, if the trader is long 100 call options with a delta of 0.5, the total delta of the options position is 50, 100 by 0.5. To create a delta-neutral position, the trader would sell 50 shares of the underlying asset. 3. Dynamic adjustment. Delta changes as the price of the underlying asset changes, as well as over time. This is known as gamma in options terminology. Therefore, maintaining a delta-neutral position requires continuous adjustment. This involves buying or selling the underlying asset as the delta of the options position changes. A comprehensive step-by-step process of delta hedging. 1. Calculate the delta. Determine the delta of the option positions in the portfolio. 2. Adjust the underlying asset position. Buy or sell the underlying asset to offset the delta of the options. 2. For instance, if the total delta is plus 0.5, sell enough of the underlying asset to bring the total delta to 0. 3. Continuous rebalancing. As the price of the underlying asset changes, continuously adjust the positions to maintain a delta-neutral portfolio. Benefits of delta hedging. 1. Risk reduction. By maintaining a delta-neutral position, traders can reduce the risk of their portfolio being affected by small price movements in the underlying asset. 2. Flexibility. Delta hedging allows traders to maintain a neutral position while still holding options, which can be beneficial if they expect significant price movements in the future. 3. Cost efficiency. While delta hedging requires frequent adjustments, it can be more cost-efficient than other hedging strategies, as it does not require purchasing a large number of options or other derivative instruments. Several financial instruments and techniques can be employed in delta hedging. Options. Both call and put options can be used to adjust delta. Futures contracts provide an effective means to hedge large positions. Equity options. Delta hedging is commonly used in trading equity options. Traders adjust their positions in stocks to offset the delta of their options, ensuring that their portfolios remain protected from price movements. Forex options. In the foreign exchange market, delta hedging helps manage the risk associated with currency fluctuations. By adjusting their positions in currency pairs, traders can maintain a balanced portfolio, minimizing the impact of exchange rate changes. Commodity options. Delta hedging is also applied in commodity markets, where traders manage their positions in commodities like oil, gold, and agricultural products to offset the delta of their options, reducing exposure to price volatility. To implement delta hedging, one must first set up a delta-neutral portfolio. This involves calculating the delta of the option position and then taking an opposite position in the underlying asset. Adjustments are necessary as market conditions change. Various tools and software are available to assist traders in managing their delta hedges effectively. Here is a quick example of how delta hedging works inside of a portfolio. Suppose a trader owns 200 call options on a stock, with each option having a delta of 0.4. The total delta of the options position is 200 times 0.4 equals 80. To hedge this position and make it delta neutral, the trader would need to sell 80 shares of the underlying stock. If the stock price changes and the delta of the options changes to 0.45, the new total delta would be 200 times 0.45 equals 90. The trader would then need to sell an additional 10 shares, 90 shares total minus the 80 shares previously sold, to maintain a delta-neutral position. Delta hedging is a fundamental technique in options trading, enabling traders to manage risk effectively while taking advantage of the leverage and flexibility that options provide. Conclusion. Delta hedging is a powerful risk management strategy that allows traders to mitigate the risks associated with options trading. By understanding the principles of delta and implementing effective hedging techniques, traders can maintain balanced portfolios and protect themselves from adverse market movements. Whether trading equity, forex, or commodity options, delta hedging provides a systematic approach to managing risk and enhancing portfolio performance. Thanks for watching.